Hey, greetings, and thank you for joining. You know who I am, Samantha LaDuc, founder of LaDucTrading, and I am with Hans. Pronounce your last name, Hans.
Albrecht.
Albrecht. He's our derivatives advisor, and we have basically hit him up to do this Wednesday at the close macro to micro options power hour, so we can kind of go over how to structure some trades, bounce off some ideas about maybe unusual flow that we see, especially in the gamma market, on the market makers and the options market and how they're dealing with it. As I have mentioned, Hans has been a market maker for 12 years, and now he is providing educational programs around how to use options, not only for directional, which is my jam primarily, but also as hedging and overlay strategies. So we wanted to make this available for clients. It will be recorded, posted, so you can kind of review some ideas, but we really want to make this available for clients to jump in and hit us up, specifically Hans, with option plays and how he would structure based on his kind of market making and hedging portfolio ideas for your portfolio trades. So that's what we're really aiming to do here, is add some value for members who want to get some structure around their option trades, who want to get more education and using options, and then just to kind of hit up ideas and bounce off the timing of all this stuff. So that's the first thing I wanted to do, is say thank you so much, Hans, for doing this, because I think it's going to add a lot of value. We'll have some fun and see where this goes. You have,
Thank you. It's great to be here, Samantha. Yeah.
You've already added great value. Clients have already given me fabulous feedback in how you've helped them around structure, around earnings trades, learn how to comfortably trade options, where before they were years and years and years, in some cases decades of stock trading only. So you've actually kind of flipped a switch in some people to demystify the fear of options, and other people, the other clients, they have just said, all right, I've got confidence because Samantha recommends him, but then they come back and say, oh my God, I just made so much money on that earnings trade I was worried about because of my hedge. So let's dig in and kind of give us a little background, your background, and how you're helping LaDucTrading clients right now.
Yeah, so as you mentioned, I was a market maker for 12 years, one of the youngest ever option specialists on the open outcry floor. So the one where you had all the hand signals and the screaming and everything, which sadly closed after I was there for about 5 years. But then I continued upstairs making markets, and it's funny. I just had dinner last night with my boss from back then, who hired me in 1995, and so we had some great stories to tell, and it was quite the world. There was one thing we did at 3:33 every day. Everyone would rip up pages of paper and yell "Oi" and throw the paper in the air, and it was like this snowfall coming down in this massive room. We do that every day. There were all these great traditions, and so then I went upstairs and traded upstairs for a while, and then became a fund manager, managing around 700 million in overlay funds. So everything from covered calls to put, protect, black swan type funds, really, really cool stuff. So, and did that for about 12 or 13 years as well. And so, here I am, aligned with you, and couldn't be more thrilled. And I'm happy to have helped a few people so far. We've really, the feedback has been, you've really helped me kind of whittle this down, a complicated topic, a complex topic that really has this very wide spectrum of uses. I mean, you can do everything from very conservative things with options all the way to get yourself in a whole lot of trouble. So there's, we want to do things that are kind of closer to conservative, but there's also lots of fun stuff to do in the middle. And so that's what I'm here to do, kind of open people's eyes. And if you already have some background in options, hey, if I can get you thinking in a slightly different way, and that's what you do, Samantha, just kind of getting people to kind of shift their vision of how to look at things, and suddenly those light bulbs go off and the possibilities are there. And I'm happy to be here to do that, to help with that.
Well, I am very glad that we could also do this weekly kind of show or brainstorming session, because the market is constantly, trying to fool the most people. And I'm trying constantly to look at the puzzle of what is underneath dynamics of the buying and selling. And I track some of that with my own indicators, and I look at the macro and sometimes also the fundamentals and consensus, et cetera, with a focus, at least for me, of market timing, sector rotation, and stock picking. That is going to set up a lot of opportunities for clients. You are coming in and you have a different approach. So I've explained how I look at it, the puzzle of the market, trying to really time the market, really time the sector rotations, and pick the best stocks directionally, and how to, and how much time they're going to be in that direction, which is very important. How do you approach markets? Let's kind of start there, and then we can kind of drill down to our respective market direction views, sector rotation views, and a few key stocks that interest us right now. And before I kind of send it over to you, apologies, of course, for my voice. I have a head cold since Monday, and I sound very odd. But this morning, I sounded like Charles Bronson's little sister. So this is much improved.
Much improved from this morning.
Much improved.
Yeah.
All right. So how do you approach the market? What do you look for?
Well, I mean, from a really high level, I think, looking at the option space, and you're going to hear this word gamma more and more. And I know sometimes people hear options and they hear the word gamma and they kind of, their eyes glaze over and they go, oh my goodness, what are you starting to tell me about here? And really, I've seen a big shift in the sort of last 5 to 10 years, especially the last 5 or 6 years, where this is something you need to be more and more aware of. Whether you trade options or not, you kind of need to know about what's going on out there. So, an example of that, for example, is the JPM caller that we have this week. And it's so big and has such an influence on markets that it's basically really sort of muddying the environment. The market from now till Monday could be very different from the market starting on Tuesday when those positions expire on Monday. And so I kind of liken it to the tail and the dog, right? So we always use this term, is the tail wagging the dog? And so options, at least when I started way back when, were infinitesimally small compared to the market. They had no, whatever I did from a hedging perspective against my options in equity markets had no real impact on anything. That has really changed in the last 5 or 6 years. And so the tail is now wagging the dog. And at some point, I think we're going to just have to say that the derivatives markets, because when you add it all up, it's not just listed options, it's the over-the-counter stuff, it's the synthetic movement from these levered ETFs and CTA buying and vol, all these crazy things that we're learning about are really having an effect on markets, and that is going to be the dog at some point. The tail is going to be the equity market. So my point is that these things have become very, very important, and they have to inform some of what you do now. So for example, right now we know, and you always have to take everything with a grain of salt, right? Like if I tell you there's a huge gamma level at 57.50, that's going to be very, very important. Now, if some news comes out tomorrow morning and there's some geopolitical issue, something big happens, that is going to overwhelm some of those things, right? That has the potential to overwhelm other factors. So we always have to remember that these are just pieces of the puzzle that we're putting together. But my whole point in this rant is that this piece has become more and more important. And I think it's leading to something that, just having done this for so long, I feel it in my gut. And that's kind of how I operate to some extent, is I use gut, and I feel that I have a good sense of direction. But I feel it in my gut, and I know statistically that we're in a world where there's sort of more of this volatility clustering. So I don't know if you guys have noticed this in the last sort of 10 years. You either get nothing happening or you get all heck breaking loose. Mm-hmm. And there's sort of this and back, I'll tell you what, in the early 2000s, late 90s, you had 3-4 weeks in a row of insane volatility every single day. Every single trading day was nuts. You don't get that anymore. You get very quiet. And that's difficult to navigate, whether you're a stock trader or an option trader. That's hard to navigate because it keeps throwing you for a loop. And so I think,
I call it something else. It prevents real price discovery.
It does. You're right. You're right. There's a whole bunch of stuff going on out there. So when we talk about that gamma, like when we had that big sell-off after CPI, we got down to 5,400. We were staring into the abyss, and we
Mm-hmm.
managed to come back from that. But we were staring into a very deep, dark hole where the flows of selling were going to start to accelerate. Now,
Mm-hmm.
somehow we turned around, and we'll never know exactly how or why. But we now have these kinds of pockets of illiquidity that we have to deal with, and that's how August 5th happens. You have this pocket of illiquidity where everybody goes, I'm not sitting in there and buying stocks, or I'm not going to get in the way of the VIX. I'm going to let things play out, and then we'll sort of pick it up later on in the day or the next day. And so it's a dangerous market, and you really have to have a plan, and you have to have a hedge, and that's where my world comes in as well. So I'm about income trading. I'm about hedging, because trading for income on the option side is a really, really great thing. It's a nice way to generate extra cash flow and things like that. But you can also encounter those markets where things start to go in the wrong direction, and you can give back quite a bit of what you made in the first place. And so my philosophy is really I have this saying, it's every successful income campaign, meaning, okay, I'm selling some puts or I'm selling some calls, I'm doing this and that, everyone ends with a loss. And that's what people have trouble with. When you hit that loss, and as a professional, you know this, sometimes you just have to cut it loose. You just have to
Mm-hmm.
say, listen, it worked, and that last trade didn't work. And if I hold on to it, it's just going to get worse and worse. So there's this, some things never change, and one of them is that the half of this game is between the ears, and you just have to evolve with it. And sometimes you have to make the hard decisions, and it's hard. I still find it hard to do.
Oh my God. And it's an emotional decision
It
when you're
is.
staring at a 3-day downdraft that causes VIX to go to 65. And you and I both know that VIX can't stay at 65. That's the
Right.
third largest spike ever. And yet it does typically take weeks and weeks for VIX to calm down. It took days. So
Yeah.
that was an outlier that's harder to predict, right? So those who had sold puts were in pain from that very, very dramatic 3-day, experience. And ever since then, VIX has really been muted because they don't want to have, this short VIX trade, which is so popular. It did hurt some folks. There's no question about it. So that big event does change some psychology. And like I say, I'm looking for the macro trigger to interrupt the flows. When you're talking about options as as the flea on the tail of the dog is how I like to call them.
Oh, you've added another animal. Yeah.
I did.
Okay.
I've added that options are the flea on the tail of the dog. They can absolutely move, right? The whole dog. But the point
Yeah.
is, this is the basic power of directional trading, is to follow the flow of the options, whether it's a market, a sector, or a stock, until a macro trigger comes in to interrupt those flows. So that's my baseline bet of how I look at it. And with that, let's kind of switch to market timing. So we said we're going to kind of address this
Sure.
in three stages, and we'll hit it, get lots of them as we get a regular kind of feel for this Wednesday. We're going to have a whole list of things that we want to go over and start really getting tactical. But I am, like you, bullish into that 57.50 JP Morgan sold call for September 30th. I don't know anybody who follows options, right? So it's really
Yeah.
pretty much a consensus trade. But as I have also written in my market thoughts, be careful then, because the first few weeks of October have traditionally introduced volatility.
Agreed.
Right? We've got the seasonality at play. We have Rosh Hashanah and Yom Kippur, which has traditionally been a saying, folklore that has some statistical relevance. Sell Rosh Hashanah and buy Yom Kippur, which is the 2nd through the 12th kind of framework. And then we also have corporate buybacks, which are in blackout until October 25th. And then they come in with a flurry for Q4. And corporate buybacks are the largest buyer of equities in the market, period. So they matter. And so this lack of buying because of earnings season, of course, coming up, is what can also create this slow, grind and also volatility where we're not really going up, we're not really going down, we're just kind of your Vanna charm language, but basically just kind of like running in place. We're running in place. So with that, given this structural roll that's going to happen at the end of the quarter with the JP Morgan collar, where they're going to figure out where they want to buy their put spread and sell calls against, what is your, and I know we've also talked about this, higher 50, for me, SPX 5820 with an overshoot to 6,010 are my upside targets for the year. I don't see anything more than that. If we get more than that, it's parabolic kind of thing, right? So how would you structure a trade if bullish into Monday, but it could be also very quick, right? It could trigger on Friday and bye-bye, it's done. End of month, end of quarter. Then we come into potentially seasonal weakness, few weeks in October. We may not, right? But let's just say probably.
Yeah.
Okay. And then we go back into the election, which you have pointed out in your channel, in fact, a very large VIX order that just came in that, and I want you to talk about that is looking ahead after the election, which is 11/5, and the FOMC meeting, which is 11/7. Am I correct?
Yes.
Thursday this year.
Yeah.
Yes, because the election is Tuesday and FOMC this year is, believe it or not, it's very confusing. Usually Fed Day is on a Wednesday, but this year it is on a Thursday.
Yeah.
So.
Okay.
And then.
That's weird.
Yeah. Is that?
That is weird.
I know. I put that on my market notes last week. I'm like, hey, wait a minute. This is, we have, because I had to count up how many prints within the jobless claims, which I'm watching like a hawk. And we have, at the time it was Fed Day, we had 8, rolling into the next Fed Day, and 2 non-farm payrolls and 1 election. So with all that said, and of course, anything can change, like you said, some macro trigger, geopolitical, oh my goodness, something. How would you structure a trade? Clients want to know for a short-term bullish, then a pullback, but ultimately 6,000. Let's just say 6,000.
Yeah, and I think the waters are muddied again because of all the things you're saying. And lately, I've been kind of getting this uneasy feeling. I was starting to get pretty bullish. I have been for a bit, and I've been.
Oh, you have. You actually said on August 5th, because you covered for me while I was on vacation that whole week. Thank you, by the way, officially, like face to face, going. Thank you very much.
Thank you.
I know we talked about that after, but the point is you covered, and on that day you said, but the market could still go up to 6,000. We still have a bullish trend, right? So you even said 6,000 back on August 5th when we were, holding up on the cliff by the edge of our fingernails. So you were right. How do we get there? How do we manifest a trade in options with a bullish bent, but with a lot of mud in between?
Yeah, and that's the thing. So I think you have to believe in the flows, and like you said, the Vanna charm stuff. The weird thing is, we in this part of this world that I mentioned before is, as the quieter things get, the more buying there is. And I know there's always some mechanical effect like that in markets, but it's more pronounced than ever because these funds that look for low vol in order to allocate more to markets have to do that. So as volatility drops, suddenly you have more bids showing up because of these sort of vol targeting funds and things like that. So I always kind of try to have these new things in my mind, not that they're totally new, and understand that. So for example, this week we have this JPM caller. And so they're really crushing vol because these poor market makers, and I did this for a long time. So I was a long gamma trader. So I know the pain of coming every day and going, oh my goodness, I'm going to lose 100 grand if the market doesn't move today. So what I have to do is I have to buy and sell the market all day long. I have to sell the rallies, I have to buy the sell-offs, and I have to scalp. So you do hundreds of trades trying to scalp and pay the theta, they call it, pay that erosion. And so these poor market makers have come in after September expiry, and everyone's trying to sell them more. So what we have is this compression, even a further compression. We can see vols come down even more, and that makes the market makers want to hedge even more strongly. So you saw we were down 20, 25 points today. We rallied back a little bit, and we're still a little bit weak, but you can see those bids are in there. But the nice thing is for us, to your question, how do we position ourselves? For October, it's kind of interesting. If you want to be a contrarian and say, listen, I think we still have a little bit of a move to come, if you think we've moved that seasonality forward. And so that's the big question, right? Things are not as normal. This isn't business as usual lately. So I always hesitate to sort of look at seasonal effects, because it feels like, well, we pulled a whole lot forward in August, and then we pulled a bit more forward on September 3rd.
Yeah.
Did that clear the table, right? Did that sort of, is the coast clear in a sense? Now you mentioned Yom Kippur, Rosh Hashanah, things like that, and then
Election.
the election, exactly. So the VIX is the interesting thing is you're going to see the VIX start to pick up. Right now it's picking up end of October, sort of 25th of October. And that's a little bit early to be worried about the election, just a touch. So next week, what we're going to see is probably a VIX rise into, I call it shenanigans, right? So what if there are shenanigans around the election, which there could very well be, because our good friend Donald Trump is involved, and he likes to shake things up. And I'm not being political at all there. I'm just saying there's the potential
I understand. His nickname is Drama. Drama.
He's
Yeah.
drama, right?
Johnny Drama.
He was a reality show host, so his sometimes his goal is to entertain, and I think he's quite good at that. So there could be some shenanigans. So we might see volatility kind of sit in here for a bit. So from a protective standpoint, I like some VIX plays. Now I'm not saying anybody get into that if you don't know the VIX very well, but I can always talk to that with folks.
But I do have your VIX. I do have your VIX post that's in your channel in Slack for clients. So
yeah, so that's an interesting one, because what somebody here is doing is they're selling a whole bunch of December 40 calls. So they're basically fading volatility. They're saying, look, we don't think the VIX is going to go bananas. We don't think the world's going to fall apart. We're going to have a president. We're pretty sure we're going to come out of that event with a president.
Knock on wood.
We'll see. I don't know. That's the one worry, is that we could push things until towards another January 6th kind of situation, right?
Yeah.
But effectively, somebody's saying, I'm going to fade that. And right now, those upside calls are extremely expensive. And that's because we still have that recency bias. We remember August, and we remember these kind of events, right? That's a volatility echo. We're still after the storm. We're still running out to buy supplies, even though we don't need them for another few years in all likelihood. So somebody's saying, I'm going to sell those expensive calls and I'm going to buy downside puts. And all they're saying is, I think the VIX is going back to 12 or 13. By the time we get to the holidays, we're going right back down. So it's a risky structure. That's not something I would do, but somebody's doing it in a very big way. So my point earlier was we're having volatility compress here in October. And I think that's an interesting way to play some upside. So if you think we're going to break out one way or the other, I think October looks kind of interesting. So you could put on a little bit of a call spread. You could buy some SPY, 570s and sell some 580s, 585s. And you might get some nice kind of cheapish kind of upside. And if you're a little bit bearish, if you think after this JPM caller disappears that, you're free to roam about the cabin again, and that's what's going to happen with the market. It's going to be free to roam about without the impact of these flows kind of clamping down on movement. You could pick up some downside as well. So I think there's some opportunities there to maybe pick up some upside call spreads or some downside put spreads against existing stock positions. So I think that's kind of one way to play it. Now, if you wanted to play something a little bit further out, December's a little bit more expensive. But
what was the month you were just referencing there was it SPY or SPX?
On SPY, I mean, you can do it in either one. A lot of clients like to use the SPY just because, it's a little bit more like a stock, right? It's a little bit more to kind of, it's cash, it's SPY settled. It's not cash settled. Sometimes you get into the index and it's a little bit more difficult to kind of follow the cash settled sort of world. So mostly students like to play in the SPY or the QQQ or the IWM, things like that.
I'm just putting it over here while you're talking about it. All right. So you would go out to December, long story short.
Yeah, I think December is going to. Now, one of the things that I always say when it comes to going along a structure, whether it's just long a call or long a put or a call spread, you want to give yourself a little bit of extra time. Now, if you think things are going to just suddenly break next week, I think October is fairly cheap from a VIX standpoint. The future is sitting up there because the future, this is where all the pieces get kind of crazy. The VIX future is now staring into the election because the October future is figuring out where VIX is going to be in November, and that's going to capture the election. And so that's why the VIX and the VIX future are so far apart right now, because they're really looking at two different things. But I like December. Give yourself some time. If you think you're going to get that nice slow drift up, don't just buy some calls outright. That's a difficult way to express your view, because you're going to get that volatility compression as the market rises. So I would do something like a call spread. So
Would you do the same for semis as well? And are you bullish? This is I don't want to put this on you as your trade. This is my opinion. So to be really clear, I don't like the market underneath. In other words, I came out very, very bearish even before the August swoon, really, on that July into August. The point is, they came in, and policy interference always works until it doesn't. So we've got a situation where it is clear, whether it be the 50 basis point rate cuts last Wednesday, or the August 5th reflexive bounce, et cetera, and volatility crush, it is very much a supported market. So even though I'm on the lookout for the things that can absolutely trigger bank weakness, again, unemployment related, et cetera, there's still a flow of bullishness, no denying. So how would you de-risking
too, Samantha? I think what happened is a lot of people de-risked in August, and as we know, hedge funds have been de-risking for a while. So I've noticed that you're sort of shorter term bullish on some of these themes, longer term skeptical, and I would say I'm aligned with you there. I think I just don't want to put words in, like, this is my idea. So I want to know if you see even semis higher in my particular world, right? Using technicals, and the fact that I still don't see any selling of size underneath the surface, and because they've come in with policy intervention, and they're not going to let the market fall before the election, period, end of point. not with any size. In fact, they're not going to let the market fall, and that is going to come they're basically throwing the little guy under the bus, because they may stoke inflation. And what that might do is, as much as I've liked some of the broadening theme, is I worry that at some point they're way overdoing the rate cut forecasts. Because I think at some point the economy is actually kind of strongish. We're seeing relatively good data. I don't know if that changes. I don't think it changes too much. And I think the thing that people may not have on their bingo cards is that we start to see a little bit of inflation, and then the Fed is kind of in a bit of a spot. And I noticed that IWM today did poor. I collared out my IWM position yesterday because I said, this thing is not acting well. The broadening theme hasn't been acting well. Now, I know there's been a bit of a rotation back into tech, and that's part of it. But you gotta admit, IWM, which I know you haven't really loved, is really not acting like rates are going to drop 200 basis points, which should be fantastic for a lot of the economy. So something's amiss to some extent, and I fear that what that's going to do is, if things do get a little muddied again, they're going to run to the balance sheet heroes, and that's going to support your idea of maybe.
When you say balance sheet heroes, you're not talking about Fed balance sheet. You're talking about the moat of growth players that have a healthy balance sheet versus small caps, which 40% have a very, very, very unhealthy balance sheet. Okay, actually, they're walking dead. So they are kept alive through all of this ZERP and then stimulus, and now for whatever reason. So money, basically just money that flooded the market in the past 4 years. So I have a different feeling about this broadening out and about the macro. So we're not going to get into too much of that because I write about that all the time, but I'm actually very bearish banks into 2025. I'm actually, for the first time in all of these years, raising my hand since June, saying I actually see a recession at the end of 2025. So I think tech will follow, and this basically this equity sell-off that I see happening obviously is completely predicated on three legs of a table, with yields continuing to fall, oil continuing to fall, and jobless claims and unemployment rate continuing to rise. We don't have that right now. And I've also been very clear that this is a topping process this year. So next year, I'm seeing the weakness. I know others don't. That's fine. But my point is, for right now, I see a gap that needs to be filled with semis. And there's going to be that kind of rotation potential into that way up here, 270. And we've already
do you like all-time highs for the NASDAQ? Do you think there's a bit of a catch-up trade there, Samantha?
Oh, I'm very bullish. The Qs into this is also posted for weeks. I still see 495. So when we had this reflexive bounce, I actually thought we were going to go there sooner. And then we rolled over, made a higher low, and now we're pushing up into that 495. That's easy. So I see very, very easy longs into the Qs 495, semis 27, NVIDIA 125.52. Something's happening after hours. We're almost there. So these have already been given, right? Like
Micron, I think.
Oh, of course, Micron earnings. Oh my God, there you go. So I see that growth rotation that I talked about. And now short term, I think jobs will not get in the way, and we'll have this run into 6,000 by the end of the year. Micron is up almost 109, which is going to make client Tim very, very happy. And it's going to ignite the semis, which is helping now NVIDIA, which is 55%. Last Wednesday, when we had NVIDIA move, I wrote about this as well, on that fateful Wednesday right here on 9/11, which is a week before the Fed came out.
Well, and
it represented 55% of the NASDAQ move.
That's right. You're right. It was unbelievable that day. Yeah. That was unbelievable. I don't know if we've ever seen anything like that.
It is the market that NVIDIA made. So how would you manifest semi 270? I guess is my
well, and that's it. And I'm starting to see some of that gamma we're talking about, that short gamma. And I mentioned last week, I put out a video, I think, saying on the 120 level on NVIDIA. And this is why we're going to get more into this, Samantha. I know you and I talked about, we're going to start to talk a little bit more about these tools and give people ideas of where there's resistance and where there's support from this, massive option flow that we're seeing. And one example of that working is that 120 level. There was a massive $2 billion worth of gamma. I mean, that's pretty big, not insanely big, but sitting there at 120, gone on Monday. And guess what? That helped out with your squeeze idea, because there was very little in the way for NVIDIA once it got going. So gamma doesn't always
I didn't know about the 120 getting removed off the board from options expiration on Friday. I just saw technically, again, I'm very bullish NVIDIA to 125. I'm looking for any reason to support it. And then yesterday, Jensen's headline that he stops selling his stock for now. And there was a Blackwell press release about, Q3 projections. So that was what it was. Today, after hours, it's clearly Micron. But yes, these are the reasons I come in with my higher market calls for SPY, Q, SMH, by association, XLK, and then stock specific Apple and NVIDIA. These are easier for me to directionally glom onto and then say, I think it's going to happen by the election. So guess what? November, October manifestation, calls or call spreads. But with a dip coming in potentially in October, that's definitely going to hurt the option traders that just go directionally. Right? October's, if we fall in those two weeks, which is traditional, then there go all the profits. So that's what I'm saying is, are you like more active in that regard, or would you just set it for December, quarterly or monthly December in a call spread, set it and forget it? How would you kind of manifest that?
I would set it and then not quite forget it, but as NVIDIA moves, so I'm sort of thinking 120, high 120s somewhere. That's where I might go in and say, you know what, I'm going to sell a bear call spread at that point to kind of cover some of the cost of the call spread that I purchased. And in the hope that we don't pull back. So now, if you're right and we start to pull back, then you are going to get rid of that. So you are going to lose whatever you made, in terms of the width of the spread, right? So you're gonna selling the bull call spread is going to pay for some of the purchase So you may not be out much in the end, but I'm looking at some things like, for example, right now, Microsoft options are screening relatively cheap. So I'm looking at different hedges um, for my overall tech portfolio. So if you're looking at, you might look like if you're worried about rates, you might look for hedges in HYG or something like that. You might look for hedges in Microsoft to cover some of the downside in technology. So there are different hedges for different themes, which is where the options kind of get interesting sometimes because SPY is expensive, right? Some SPY downside hedges can be a little bit more expensive. The skew is very, very steep. So to protect that downside, I think you're just going to want to be nimble. I think if you grab some of that upside in SMH or in NVIDIA, you're probably just going to want to scalp that out, right? You're just going to have to get out of that position.
How do
And
you hedge profitable, like ETFs I have mentioned in the past few weeks, in my estimation, because we'd have this growth rotation, right? Specifically semi,
yeah,
the long swing trades in XLP, XLU, XLV would come under distribution with bonds. Now, for honestly, XLU did not, right? We had this 3 Mile Island news that came out. Microsoft is heavily
right.
invested in nuclear, and XLU, because of its components, two key components went hot fire flames, and it didn't pull back. The others did. So how would you recommend for clients? I'm going to put this up here again because I think it's better to kind of demonstrate with an actual chart. Hold on.
Yeah.
So I'm talking about over, like, look on the weekly because I like that time frame, right? So first of all, TLT worked like a charm in coming back, right? This
Yeah.
is still okay. So that was, if I'm long big picture TLT, but I see a digestion period. Fed comes in, believe it or not, I think we're going to have a yield spike. I write that. Clients are just like, okay, what do I do now? So for me, it's more of a put spread situation until it pulls back, because then I think it's going to get defended, turn, and head higher. How do you, in that situation where it's a long that has worked, but it's going to go into distribution, you can see it on the daily. Same thing with XLV. This one also started, same thing, a whole month of which, and it's still softening because it's all part of the defensive, trade. XLP,
Yeah.
same thing. This is all part of the same trade.
Yeah.
Bonds, XLP, XLV, XLU, recommended since May. So
Back
the point,
into
and now
tech. Yeah.
pullback.
Yeah.
So for clients, if they're long into a theme, how do you suggest they protect in a pullback?
I think once you sense that correction is underway, right? We don't know. Unfortunately, we don't know until it begins, and then it starts to confirm you that confirmation. And then I think it can get as simple as basically putting on a collar. I mean, I think you can sort of get in there, sell TLT calls at the 100, 102 level. It depends what you're looking at. Like if I look at
Yeah, 101, 102. Yep.
yeah, 101, 102. I've been doing callers on a bunch of different things so far. I'm going out to December, just sort of, but I'm picking what a lot of people do with the callers is they look for a costless caller. And I don't think that's necessarily the way to go. I think, especially if you're up money on some of these things that you're talking about, I think you can sacrifice just a little bit of that. So you could sell an out of the money call for $2 and pick up a put for $4. Your net outlay is going to be $2. So you're going to sacrifice some of that gain that you have so far, but you're going to be able to be more aggressive on the put side. You're going to get a much more effective strike, because part of the problem with callers sometimes is that put strike is pretty far away. So you have that pretty heavy deductible where the thing can come down a fair bit. Now, if it's a long enough duration, it's still going to be effective for you, right? It doesn't have to get to the strike price before it's effective. So that's the nice thing about giving yourself a little bit of time.
How much time? Because, for example, in all of those cases, except XLU, they would have worked with even a month out, 2 months out. But in the case of XLU, it didn't. It just kept going higher because of the nuclear kind of, resurgence. But
Yeah.
in that case, would you have gone back in to defend, or just basically, take it on the chops because the puts aren't paying, they're losing money, and the sold calls, well, They're
They're
doing
not
their
giving you that
job.
much. Yeah.
Yeah.
So, well, I mean, I think you give yourself 3 months. I always try to give myself about
Okay,
three
that's the
months.
question.
Yeah.
So
So
then that's
that,
not going to matter just to real returns if you are going out 3 months. So
yeah.
that's what I wanted to ask as well. How do you kind of structure? For me, if I'm doing something like when I said yesterday, Nvidia looked like it was going to have a squeeze. That was on an hour chart. It was going to happen in the next day or two. It wasn't something that was going to linger. It doesn't need a 3 month option.
Right.
But
Right.
in the case of it's time to protect XLP, XLU, whatever, XLV, because defensives look like they're going to come back in a little bit,
Yeah.
right, with bonds, and the growth is going to pick up, namely semis, NVIDIA, SMH, then that's where 2 months out is my preferred. We're kind of aligned on that.
Yeah,
Whether it works or
exactly.
not is to be determined.
Because what you want to do is you want to give yourself a little bit of Vega exposure, right? So if you one of the best examples of this is if you look at 2022, a lot of people were trying to buy short-term puts, and it was a really poor strategy in that year because it was a fairly measured, like it was a difficult year, but it was a fairly measured drop throughout the year. We kind of had some bear rallies and there's a product, the CBOE short-term put index actually did worse than the S&P that year. It was down 22% and the S&P was down 20. And you have to wonder, well, how could that happen? It owned puts. Well, it owned short-term puts. And that's one of the places I see people get into a lot of trouble. And I try to really push students away from that because it's always tempting to go for the cheapest premium. But the cheapest premium is often the one that kind of gets compressed to nothing very, very quickly. So you always want to jump into that 25-cent put, but it's probably, throwing money in the garbage. So you want to give yourself time. That's called Vega, so that if things get ugly again, right? So if XLU suddenly gets ugly for some reason, they unwind whatever VST and all these power on trades that are working.
Producers. Yeah.
You're going to get a pickup in volatility, and you want to benefit from that. You're not going to benefit very much from that if it's a short-term option. So you want to position yourself. Now, you are risking that it'll keep going. So I'll tell you right now, I have a collar on VST, and I put it on before this crazy stuff went, the Texas utility, that's the nuclear.
Oh, yeah, I know it.
Yeah. Great stock.
Yeah,
Just went from 75 to 120 in a hurry. And so I'm collared on that. So I have, but I think the thing is, once you're up a good amount of money on something, there's a certain amount of acceptance, and you sort of go, okay, well, I'm going to be happy with, I have to be happy with 110 right now. And it may go to 130. What am I going to do about it? So, but there's that's the cost to protect a position. Sometimes it just is what it is. Yeah, there you go. VST 120.
Yeah, it's a mammoth move. And this whole thing has been a beautiful trend, right? Which some of it was powered by AI, and then it actually came back down with NVIDIA, and only recently went here and here because of the 3 mile, and uranium the kind of show. So it's a very extended, and it will probably just come right back down base and figure it out after that. So your collar will be fine. But when you do have this type of standard deviation move, which is much more than you, I'm sure, expected in your collar, are you actively repositioning that, or is your 3 months enough time? You're kind of taking the lumps for the short term, assuming that it's not going to stay elevated because the mean is actually more towards this area. Kind of like that big spike.
I think I'll wait for it to relax a little bit and reposition. So, my motto is don't panic. Just, you wait it out. Markets are going to do crazy things. And right now this is the hot thing. It should come back in at some point, right? It's not a cheap stock. So, not that that's all that meaningful, but, sometimes it matters. And so we could see this thing come back in, and that's where I would consider repositioning my trade at that point. But at this point, I'm just going to kind of leave it alone and possibly add to the trade. So if we see 50% retracement on that recent move, I may add a little bit to the trade and consider that a whole new trade.
Got it.
To keep it simple. Yeah.
Do you ever kind of differentiate between, for example, when Tesla, way to heck back here, let me just kind of go here. I know it's messy, but just humor me for a little bit. When Tesla did this inclusion, right, in the S&P,
yeah,
was the run up. It was crazy. We also had policy interference of size back in October of 2022. But this thing was also allowed to enter the S&P, and it just was a gamma squeeze for the ages, right?
That is incredible, yeah.
So callers in that particular case, you're
difficult,
covering.
yeah.
Well, they're very difficult. You're covering into higher and higher and higher prices, pushing the price higher and higher. So not only was this S&P inclusion with shorts, with a gamma squeeze, with callers, dealers chasing higher as well. I mean, how do you differentiate between when it's going to soften and when you're just at the well?
Yeah, I mean, that's tricky, right? And so I do have a rule that I wait for if the delta on my call hits 65 a couple days in a row, and that's also supported by a breakout beyond. So you can see there in that part of the chart that you're looking at, there was that beautiful breakout on that downtrend line, same as the VST, beautiful trend breakout. And I use a couple of indicators. I have one that I've created, the MTI, and so it goes yellow, green, red kind of thing. And it's worked really well on Tesla lately, actually. And it kind of gives you an idea of when that momentum is turning. If it isn't already obvious on the chart, it sort of helps to kind of indicate when those moving averages are starting to point in the right direction. And once it goes green, if that's supported by a trend line, if that's also supported by my delta rule, then
you've got
then I'll
technicals
cover.
and options that you're kind of
Exactly.
pairing as your guardrails.
Exactly, because I mean that's the key, right? If you can sell an option for $10, but it could be worth 150, like on that Tesla chart, you run over terribly, and so that's a performance killer. And so you're right, it's art and science, but you have to always come back to a bit more of the science and, push the emotion out of it and say, well, you know what, look, this call is under threat. It's a 65 delta. There's a pretty good chance it's going to get worse. I remember I did this on NVIDIA when it went from 500 to 590, and it was a clear breakout, and I covered the calls according to my system. And I ended up saving myself like $70 on it. So it was meaningful. Now, sometimes you're going to cover a call and it's going to come right back down and you're going to feel silly. But if you stick to a process over time, I think it's something that's going to be beneficial.
So do you share your process? In other words, you kind of gave a little nugget there where if it gets into the 65 delta area, you're on alert, right? Yeah. So you let that also prove for the next few days, you're not jumping right on it. You're going to have to use some of your trader's gut when it comes down to it. But and I don't know about this kind of like the personal indicator that you use. I'm just curious, do you have a kind of a system that in options specifically that you share?
Yeah.
Or is it something that you kind of like tweak? Because that's when you just said 2022, it didn't fall fast. And it was very hard for those who were doing directional puts to make money, and very frustrating. They were completely right on direction, but very, very wrong in losing money on their options and strategies. And I think a lot of people were actually forced into this, not forced, but went into this zero DTE craze because they really could just maximize that day. Yeah. And it was easier than swing trading. So sometimes the conditions of the options market change and you have to change with it. Anything right now that you see with a kind of unusual flow or some stuff that you kind of highlighted, like in the Slack member workspace, you put that VIX trade, not one that you'd recommend, but it's sizable. They're expecting volatility to soften after the election, which we'll see. But right now, that's not the macro narrative, but for sure, we'll see. Any option flow or levels that you're kind of seeing in the gamma crowd, any particular stocks that look really ripe right now? You know, the ones I'm very focused on right now, NVIDIA and semis for that rotation and weakness into the first part of October, potentially.
Yeah, I mean, I like, I love Uber. I think Uber is going to $100. I'm a big fan of that one. Yeah, I remember you talking about it a couple months ago. You were kind of.
I actually just took let me just bring this one up because literally I like this again, and it's so painful because it didn't work last time. It
did have a big shakeout. You're right, down
huge. So
It's a you gotta believe stock. It's a you gotta believe stock, and you're right, it'll shake you out.
So I do, let me just kind of go back again. This is weekly and it's mammoth and all that stuff. But for all of this time, zero interest, right? Absolutely nothing. And then something happened over here, and I want to just kind of bring it back. Oops,
Yeah.
that's not really what I wanted to do. All right. I remember when this gapped up and it was a monthly level and it was the first time they were profitable. Then it made it on my radar. And I've remembered it ever since because I was just like, but it's Uber. Is this really going to work? Right. And it wasn't like we were in a bad setup for tech stocks. January 2023, you know what happened with the NASDAQ. It bottomed and we're up 92%, into the July highs. So we had a nice backdrop for chasing tech. But then fast forward a little bit. Sorry.
It looks like it might have taken off during the banking crisis because it started to get going in May. So that probably was, you were probably looking
May
at
was
it
actually NVIDIA. NVIDIA was the AI extravaganza. So tech really got a lift too. March was the banking. But this is definitely, we came back down before the quarterly refunding announcement. And then everything looks like this on November 1st. Everything has this massive candle because of the Fed pause and Yellen Yahtzee. That's called policy interference. So this is when it got very interesting again, right? But the shakeout was actually after it came back. I forget even when it was. Here, because I remember you and I were both looking at this. You had just come in, right? And we were both looking at what looked good, and it was Uber. And I said, well, if it can get and stay above, right, this kind of 75 area, and then it completely dumped into the August 5th low, got firmly supported. I mean, talk about a bear trap right there. Look at that V shape. So you like this one, and maybe this is a position for you, or is it a swing, or how do you what's your time?
It's more of it's a position. So it's a position. I have a little bit of stock, and I actually have some in the money calls. So if I feel very strongly about something, I don't mind putting myself out there with some in the money calls. I look for something maybe around a 70 delta that doesn't have a ton of time value. It always is going to have a bit of time value, but the nice part of that is that you're getting into Uber for a lot less than, $70 or whatever it is. And you sort of have that built-in protection, right? So it's going to, if it fails and comes down, you're going to start that strike. Let's say it's a 50 strike or a 45 strike. It's going to start gathering that time premium again. So you're going to almost have this sort of embedded, protection in there, partially because you've only spent $20 on it instead of 70, but also you're going to have the effect of volatility, which is going to rise probably into sort of a drastic sell-off, unless it's on earnings. Then they'll take the volatility premium out of it. So it's a kind of nice way to play something for upside because you have that limited downside. So it's in a way, it's kind of, you can almost do that in lieu of having a protective put. So I can own Uber with a protective put, or I can own some deeper in the money leaps or longer term options. And you kind of get the same effect in a way because you're paying a little bit of time premium for one, and you're paying a premium for puts. So it's kind of, one or the other in a sense. So I have a few positions like that. Do you get the 70
in the 70 delta in the money calls as well as puts? Like where do you put your delta?
No, I'll just have the calls on their own. Now you have to keep in mind that once you get into options and you start doing in the money leaps and things like that, you have these sort of, like when you trade options, you have events. So if I own Uber, I can own it for the next 20 years. And I don't have a taxable event if I don't sell it. With options, you're going to create events. And that's what's one downside to this particular strategy. Yes, there are some advantages to that. And that's great if you're a trader, and it's great if you're sort of, more of a slight trend swing kind of person. If it's something that you really want to own for the next 10 years, then, you probably just want to own the underlying at that point.
Okay, I'm just bringing this up for your assessment, not that I'm promoting like Dash because I don't know it, but I do see I got a trigger this week in that it popped above monthly resistance, which happened to be the prior high in March of 2024. So, and they're kind of sort of in the same business, right? You got to it's transportation to get your food. But the point is, Uber is partnered and all that kind of stuff. What would you do with something like this? Options are way thin. Would you avoid completely? Or
Let's take a look here.
Yeah.
Yeah, probably. I mean, the volatility, first thing I do, look, everything stems from the stock. So if you don't believe you have to really believe in the underlying story. Now, some people will trade options just because they see edge somewhere. And that's one way to do it. If you're trading in the S&P pit and that's your job. But if it's on a stock or an index, you really, really have to understand that it all starts with the quality of the company. So I don't know if I would touch a DoorDash just based on the quality. Now, it's looking okay. My indicators are showing sort of 5 green, which is good. That looks good.
Can you show us what you mean? Because
sure.
When you say your indicators, I don't know which.
Yeah. So if I have.
Here, I stopped sharing.
Okay.
Hit it.
Okay. So I've got this indicator here where when it's green, it's kind of good to go. Sometimes you get into a yellow, which is a little bit more caution. Maybe use that to sell some options because you might be going sideways for a while. Here you can see things get kind of yellow and red for a long, long period. And that's telling you if you have no position, don't get in. It's time to be very, very cautious with this stock. If anything, you just want to sort of trade sideways action if that's your thing, to trade back and forth, kind of scalp. But in terms of looking for longer term trends, I like that this is starting to get much more positive here. Now, this says 4, but it's actually a 5 if you take out the VIX. The VIX right now, I think, is artificially kind of a little bit high given the market movement. So really, this is acting quite well with a sort of 5 out of 5 green. This is the shorter term one. This is a longer term one. So I would look at these indicators, which I won't lie to you, it's a bunch of moving averages, the MACD, SAR. It's nothing too complicated, but it is something that often keeps me out of trouble because sometimes something will just start to run and everybody wants to be the first one in, and it keeps me out of trouble. It sort of says, well, hold on a sec, Hans. There's no need to rush into this. Wait till it starts to, how moving averages need to unravel. They need to kind of, they're like a ship that needs to be turned around. It doesn't just.
Oh, 100%. No, everyone gets so excited, and I'm like, all you're doing is bouncing into a solidly, extended downtrend or descending 200. It's going to take months to turn this ship around. Yeah, I say same thing. Yeah,
exactly.
It doesn't mean in time you won't be right, but how long do you want to hold it before it actually goes through all those gyrations and becomes a durable long, like the Uber. The Uber did actually not only have a fundamental trigger higher, a technical trigger higher, but it did absolutely change the direction of that 200-day. And then the 200-day was behind it, underneath it, and it continued to pull it upwards. So yes, I look at those as well. You have an indicator, it smashes them all together. That's all good.
Yeah, it's kind of good. It's Momo. It just gives you an idea of Momo. So yeah, I mean, on Dash, so I would look at those options and I'd say, well, first of all, I would look at the level. So right now we're kind of 40, Dash can get as low as say 31. It's in the bottom kind of 22% of sort of a 52-week range. So they're reasonably priced. It's something where you might, if you really believed in this, you could sort of look at, maybe like a December or January. December's tricky because, it gets very, very quiet and that can be frustrating, but you could look at something like a December, like a December 160 for $6, maybe 155, do a call spread. One of the trades I really like is a risk reversal. So this is one of my favorites, is when you feel like a stock has really had a good run, you don't really want to buy it here, but you still want to participate in the upside. What you could do is sell like a 110 put, which is way out of the money at this point. And you could use that to finance an upside call spread of some kind. So you could buy like a, 7.
Oh, that's a financed call spread.
Yeah, finance call spread, exactly.
Okay, so for me, a risk reversal is, you sell a put and buy a call. You're doubly bullish. I love financed call spreads and put spreads. Like the JP Morgan is a financed put spread. I love those. Those are my favorite option tactic. It does require margin, and management. I don't actually really think that it's for everybody, but
right.
Yeah, I'm crazy about those.
It's definitely something that now you can cut down on that margin if you sell the put spread instead of just selling a put, then at least you're
Mhm.
limited to the width of the spread. So that's one, but you're going to get so much less premium for that put spread. But
Yeah,
one of the
yeah.
things I like to do is, and so for example, sometimes in something like SPY, you
And
get
by the
the
way, I like to do a finance call spread for scratch. I'm one of those.
okay, okay. That's all right.
So
It's nice to
I like to find one that is like 25 cents. That's perfect debit. And it's of course because I'm convicted of a particular direction. But I also know that it needs to be defended because it can very quickly, fall ill
it
if it doesn't
could.
have enough time and
And well,
the
one of the
right
things,
strikes.
one of the things that I encourage people to look at a little bit. Now, it's sort of a next level of option trading, but it is important too. And you look at things like skew. So skew, this is the SPY skew, the SPX skew for that matter. And so you can see that those out of the money puts are very expensive. This is the level of option pricing versus the out of the money calls. So that's where your financed upside gets very, very interesting. When you get this pronounced skew, you can sell an out of the money put on the SPY and finance an upside structure like just a call or a call spread. And that can get very, very cheap because oftentimes they're already compressing that upside. Why? Because people like me who used to run all these covered call funds come in and they go, well, I got 10,000 calls to sell today. And guess what the market makers say? They go, oh, really? I'm going to give you a really great price for those. And they lower their bid and they give me an awful price. So the upside often gets compressed. And so right now, for example, and Goldman really called this well back in December. They said, you know what, upside is very, very cheap right now. And so they have something called their E-move index, I think it's called. And
Don't know.
they'll price what they think the upside potential is versus what the market is pricing it at. And so, for example, right now, the market
Mhm.
is calling for I think 5% upside, and they're saying
Which is
there's a
6,000.
there's a yeah, they're
Yeah.
looking, they think that the upside calls are actually cheap relative to what they think the potential is in the market. So it's upside. People often focus on the downside, and I think that often makes upside really nice, especially in a climb the wall of worry kind of market where everyone's going, I don't
Mhm.
understand why we keep rallying. That's when everyone's crushing the upside and they keep buying the downside. And guess what's cheap? The upside. So that's where you can kind of go in and go, oh, you know what? I'm just going to buy some upside call spreads. They're super cheap.
Yeah.
Um,
And that's the call spreads are definitely getting I think bid up for this 6,000 target that is a little consensus on, which typically means we're going to go test those bulls, right?
yeah,
We're gonna go down first, but maybe not. Maybe it's a straight line. We just had Micron, results. We've got Nvidia and semis in the house. We've got Nasdaq that's going to run higher because Nvidia is running higher. So let's see what happens on Monday, the 30th. I did want to make this available to clients to kind of ask if they have any particular trade that you want to set up. I know it's already been an hour, we've been yakking, but it's mostly, new for us, right? We're kind of like getting into the rhythm of
sure.
what do we want to present for, it's not really so much macro as it is market direction. And then, of course, how to manifest trades for clients, best way given your education, which by the way is available for clients. They want to get more of your instruction. We have got fabulous. This is one of the reasons why we partnered, right? It was absolutely to bring in your expertise and training because I'm very busy with market analysis and writing in a live trading room and setting up trades, but not necessarily teaching options. This is definitely your passion for teaching options very much comes through, and clients have been thrilled. So we do have that again incentive for clients that want to what do you call it, level up to the next to the next kind of lane of option education. But if there are any clients that have any questions, I know we're going to do this every Wednesday. It doesn't have to be today, it can be next Wednesday. And you also know where Hans is camped out in our Slack member workspace, so he's got his own channel. You can reach out to him there. But if you do
Yeah,
any
if you want me to cover if you want Samantha and I to cover a couple of names, drop some names in my Slack, and or feel free to come by anytime and just say, hey, what do you think of whatever? And
Correct. That's what I want them to feel comfortable doing.
yeah.
I have one that a client asked me about, and I honestly, it's such a painful one because it's here. Let me just show this to you real quick. So,
Sure.
for example, Toyota. This was a recommended, and it worked great, no questions about it. But it has in other words, as a long, and then it got into some distribution with the Nikkei.
I'm still sharing, Samantha. I'm still sharing, by the way.
Oh, okay. So undo that if I could real quick.
Oh, okay. Stop share. Oh, there we go.
Yeah. Sorry about that. I forgot that. So this is just a case in point. And I want difficult questions because this is how we proceed to kind of capture these trades. So at the time, Toyota back in this time frame was a fabulous recommended long, no question about it. Got a little above its skis. Nikkei pulled back. It also got a recall. It got hit hard. It's trying to base and move higher. I've got levels where it becomes bullish again. But the biggest issue is this. I've got clients that made money off of this, right? And also knew that it was going to come back down. But now we're trying to position for this, great stock, relatively speaking, but very, very tough price to trade when options are so few and far between. When you have a stock like this, how do you advise? Because options are, look at this. This is the whole world, right, of options. The
spreads are pretty bad. Yeah, it's a Japanese stock. It's a funny thing, the options world, it's no different than the equity world where everything is sort of, the option volumes are really concentrating in a few names, just like so much of them, it's the same thing happening there. So sometimes it can be difficult to transact in some of those other ones. I would say that always test the market. So if you see something with a wider spread, 1050 to 1150, don't just pay the offer. Don't just sell on the bid. Get in there. What I like to do is put in a bid at a reasonable level that I'm comfortable with. Wait 30 seconds. If it doesn't work, move it up by a nickel. Wait 30 seconds. So it's just use the 30-second rule and continue, because really there is liquidity, but sometimes you have to source it. It can be hidden. They're hiding in the weeds there, and sometimes you just have to source it.
That's a good way of putting it. Yeah. I know some clients are making a market and they don't mean to. I know some clients are very, very gifted at options and they know exactly what market to make, right? So they want this and they know how to position because they know that, whatever. But your advice on something like this, whether they're long and needing to protect or they want to go in using options because it's, still $184, is there anything there that you would see, and you've got your own system, right? That if you are interested in Toyota, how would you play this with options? I find this very difficult, honestly, because it's not robust. It's not a deep enough options market.
It isn't. Most of the liquidity is probably elsewhere. I'm looking at January 2025. The 195 calls are 640, 680. Could be worse. It could be worse. The 200s are 495.20, but not a lot of trading going on there. So unfortunately, you probably do have to, there's going to be that slippage that you have to deal with, which is, paying up. And then once you get out, if you do need to get out, you're going to have to deal with that spread again. So it can be tricky, but I would, you can certainly try to play something like this and put in a structure if you want to, figure out what you want to pay for a call spread. And most systems will allow you to sort of enter that order as a spread or even a full condor or whatever it is you're trying to do. And you never know, you could get filled. But generally, you want to stick with the more liquid names. Yeah. With a Toyota, you're probably just kind of stuck with the stock. Those aren't terrible. You could do something on there. I could sell a 200 call, probably get $5 for it. So there's some premium there. It's not that the premium is anemic. It's just the wide spreads are difficult to deal with.
A little, sometimes it's Hotel California. It's easy to get in, but not out. So this is,
that's right.
But these are the types of stocks, and sometimes biotech too, right? Alexander is brilliant. Oh my God. And Alexander's, Kenton's corner of biopharma. He just knows that space, healthcare and rest. Well, big names, of course. UNH has tons of options, but some of the biotech plays coming up do not. And it's just a better stock than an option. So anyway, I know, and I know that he's a client of yours now. So he's adding these overlay strategies on his biotech names, again, for protection and for alpha. So,
Oh, that's good. That's
yeah,
good.
he's very excited about that. But this is it. I just wanted to kind of, these are some of the questions we'll go over on a Wednesday, and we'll get clients to kind of participate and add their top picks and how you and I both see them using options.
And we can talk next time, Samantha, we'll talk about a repair strategy idea that I have for something like a Toyota or something that, you're underwater on. And we can talk about how you can kind of recoup some of that by doing a certain kind of spread. So we'll talk about that next time.
Oh, I think that'd be a very good idea, because I do know some folks that love to bottom fish. I do not, because I have a just experience that says you don't buy new all-time lows and you don't short new all-time highs, but they love to time a rotation or what have you, and then they get stuck. So how to repair when it's clearly not in the direction that you thought. I think that'd be a great topic for next time. All right, I'm going to rest my voice, finish my tea.
Yes.
And thank you so much for this time, Hans. I really appreciate it. I wish you a great rest of the evening and trading week, and we'll hit it again next Wednesday.
My pleasure, Samantha. Have a great night.
Thank you. Bye-bye.
Okay, bye-bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.